Imagine sending money to another country. Your bank updates a database, another bank updates its database, currency gets exchanged somewhere in the middle, and the final recipient may still wait days for the payment to fully settle. XRP was designed for a different approach. So, what is XRP? It is the native digital asset of the XRP Ledger, a public blockchain built primarily for moving and exchanging value quickly. Transactions usually reach finality within seconds, without Bitcoin-style mining or staking validators competing for rewards. But XRP is not Ripple. It is not a stablecoin, and owning it does not give you ownership in Ripple, the company. Those distinctions are essential because three related names often get mixed together. The XRP Ledger is the network. XRP is the network's native asset. Ripple is a technology company that develops payment products, contributes code to the ecosystem, holds XRP, and uses XRP in some of its services. The ledger is open source and can continue operating independently of any single company, although Ripple's role and holdings remain important parts of the conversation. The original problem XRP tries to address is settlement, especially when money moves between currencies. Traditional international payments can involve correspondent banks. A financial institution may also keep money in foreign accounts, so it can fund payments in different countries. That system works, but it can lock up capital and introduce extra steps, fees, delays, and reconciliation work. XRP can act as a bridge asset between two forms of value. Instead of finding a direct market between every possible currency pair, a payment provider could convert the first currency into XRP, transfer that XRP across the ledger, and convert it into the destination currency. Here's a simplified example. Alice wants to send value from the United States to Bob in Mexico. A payment provider accepts Alice's dollars and finds a venue with enough liquidity to exchange those dollars for XRP. It then prepares an XRP Ledger payment to an account controlled by a recipient or another payment provider. The sending wallet creates the transaction. It includes the destination, the amount, a sequence number, and a small fee. The wallet signs that information with the sender's private key. That signature proves the account authorized the transaction without revealing the private key itself. The signed transaction is sent to an XRP Ledger server and relayed across the network. Validators compare proposed transaction sets and work toward agreement on what belongs in the next ledger version. Every server then applies the agreed transactions using the same protocol rules. When enough trusted validators report the same result, the new ledger becomes validated and the transfer is final. On the receiving side, XRP can be exchanged for Mexican pesos. Bob may receive pesos in a bank account or another payment app without ever personally holding XRP. That entire route depends on more than blockchain speed. The exchanges need sufficient liquidity. The provider needs access to banking rails. Currency conversion introduces spreads and possible slippage. Compliance checks can add delays. The XRP transfer may settle in seconds, while the final bank payout still takes longer. If you like explanations that separate what a blockchain does from what the marketing says it does, subscribe. Now let's look at the unusual part of XRP's design. Bitcoin protects its transaction history with proof of work. Miners spend computing power and electricity, and the winning miner can earn newly issued Bitcoin plus transaction fees. Ethereum and Solana use proof of stake. Validators lock or delegate assets, participate in consensus, and can receive rewards. The XRP Ledger uses neither model. It has no mining race, and validators do not have to stake XRP. They also do not receive XRP rewards for validating. Operators typically run validators because their business or community depends on the network remaining reliable. A validator is a server that participates in agreeing on the next ledger. It does not get to rewrite balances or approve invalid spending just because it is trusted. Each server independently checks signatures, account balances, sequence numbers, fees, and other protocol rules. Validators mainly help the network agree on which valid candidate transactions to process next and confirm that everyone calculated the same result. The trust model is where things become more nuanced. Each XRP Ledger server chooses a set of validators whose messages it listens to. This is called a unique node list, or UNL. Server operators can build their own list, but many use recommended lists published by established organizations. These lists need significant overlap, so servers do not split into groups that recognize different ledger histories. Consensus normally requires a supermajority of trusted validators. If too many trusted validators are offline or disagree, the safer outcome is that the ledger stops finalizing new versions rather than confirming conflicting transactions. Supporters argue that this design avoids mining's energy cost and proof-of-stake's tendency to connect influence with token ownership. Critics point out that recommended validator lists create a social coordination layer. Publishers do not control accounts or create XRP, but they can influence which validators are widely trusted. Operators can choose different lists, yet making dramatically different choices can increase the risk of diverging from the broader network. That is one of XRP's central trade-offs. Its speed comes partly from using a known, highly overlapping group of trusted validators, rather than an open competition where anyone with enough computing power or stake can immediately influence consensus. So what is XRP itself used for? First, it is the native asset recorded directly by the XRP Ledger. It does not depend on a separate token issuer or smart contract. Second, every transaction destroys a tiny amount of XRP. The fee is not paid to a miner, validator, or company. It is permanently removed from the supply. The main purpose is spam protection. If someone floods the network, the required cost can rise with network load. Third, XRP is used for account reserves. An account must keep a small amount of XRP reserved, and some ledger objects can increase that requirement. This discourages attackers from filling the shared ledger with millions of abandoned accounts and objects at almost no cost. Fourth, XRP can provide liquidity. The XRP ledger includes built-in exchange functions, including order books and automated market makers. A payment can potentially use available exchange paths to move from one issued asset to another, with XRP acting as an intermediate asset when that route is useful. XRP supply also differs from mining-based assets. 100 billion XRP existed when the ledger was created. No additional XRP is mined into existence, and the amount slowly decreases as transaction fees are destroyed. A large portion of the original supply was given to Ripple. Ripple later placed much of its XRP into on-ledger escrows that release according to a schedule. Unused amounts can be placed into new escrows. This creates more visibility than an ordinary company treasury, but it does not eliminate concentration concerns. Ripple's holdings and decisions remain a risk factor that beginners should understand. The XRP ledger is also different from Ethereum or Solana in what it emphasizes. Those networks are designed around general-purpose programs that developers combine into complex applications. The XRP ledger's base layer focuses more heavily on built-in financial tools, such as payments, issued currencies, exchange offers, escrows, payment channels, and token features. That narrower design can make common payment operations efficient and predictable. The trade-off is that developers do not get the same style of unrestricted base layer programmability found in large smart contract ecosystems. Now we can explain RLUSD. RLUSD, short for Ripple USD, is a dollar-backed stablecoin issued by Ripple. It is designed to track the value of $1 and is issued on networks including the XRP Ledger and Ethereum. RLUSD is not a renamed version of XRP. XRP is the native market-priced asset of the XRP Ledger. RLUSD is an issued token backed by reserves held outside the blockchain. Those reserves can include dollar deposits, short-term US treasuries, and cash equivalents. This means the blockchain can show how much RLUSD moves between addresses, but it cannot independently prove that every dollar of backing exists in a bank or custody account. Users also depend on the issuer, reserve management, attestations, legal agreements, and redemption access. That is normal for a fiat-backed stablecoin, but it is a very different trust model from XRP. Here's how an RLUSD transfer can work on the XRP ledger. Before receiving the token, a user's account may need to create a trust line to the official RLUSD issuer. Despite the name, a trust line does not mean blindly trusting every token with the same ticker. It identifies a specific asset and issuer and records that the account is willing to hold it. The user signs a trust set transaction, and the ledger records the trust line. The user can then receive RLUSD from an exchange, payment provider, or eligible issuer service. When the user sends RLUSD, the wallet signs a payment transaction. Validators finalize the ledger update, and the RLUSD balance moves across trust lines from sender to recipient. A small amount of XRP is still used for the network transaction cost. The asset being transferred is RLUSD, while XRP pays for the ledger operation. If an eligible customer redeems RLUSD, the tokens are returned through the issuer's process, and the customer receives dollars through traditional financial rails. The on-chain transfer may be fast, but bank settlement and compliance procedures can still affect the complete redemption time. RLUSD gives the Ripple ecosystem a stable value settlement option. XRP offers a neutral native asset that can bridge different markets. The two can complement each other, but neither makes the other unnecessary. RLUSD still needs a blockchain for transfer, while XRP can still serve as the native fee asset and a source of liquidity between assets. The bigger lesson is that fast settlement does not remove every risk. XRP can fluctuate in value. Thin markets can create slippage. Exchanges and custodians can fail. Payments are generally irreversible after validation. Issued tokens introduce issuer and reserve risk. Validator list coordination creates a different security assumption from mining or staking, and anything involving banks still inherits some limitations of banking. XRP remains widely discussed because it represents a distinct blockchain design. It prioritizes rapid finality, low transaction costs, built-in asset exchange, and payment-focused features without relying on mining or validator rewards. Whether that design is appropriate depends on the job, the liquidity available, and which trust assumptions a user or institution is willing to accept. If you still have questions about XRP, validators, trust lines, or RLUSD, leave them in the comments, and tell us which crypto mechanism you want explained next.